We are at the Grand Central Terminal in New York, which is really the largest terminal in the US. And at this very historic location, I have with me a very special guest on the show, Mr. Arvind Sanger, who's the managing partner of Geosphere Capital Management, a fund that manages about $1 billion worth of assets. Of course, it's also a long-short fund, so he really knows the dynamics that are playing out in the market across the emerging market pack, as well as what's happening with developed markets right now. Mr. Sanger, great to have you on the show. Thanks very much for taking the time out.
Thanks for having me.
You know, before we talk about your strategies and all of that, I'm very inquisitive to know, how did you get into the whole business of trading and finance?
I came to the US to do an MBA. Unlike most of my classmates who came here to do a master's in engineering, I came to do an MBA, and that's when I,
and you knew that finance was your calling.
Finance was definitely what I wanted to do, and then after that I got a job as a research analyst, and then one thing led to the other, and today I'm investing, trading, and managing money.
But you knew that you wanted to get into investing because your first job after your B school was in the field of commodities. What do you foresee over the next 10 years? And I know that's a long term, but in the commodity cycle, how bullish are you? You think the chunk of the gains have already come in, and perhaps you need to be a little more selective in your strategies there?
Well, if you're taking a longer-term view, and a 10-year view is kind of what I would take when I establish my business, because that you can't change your business every day, then we're very constructive on the outlook for commodities, because we do think that global growth on a long-term basis, notwithstanding the near-term challenges, will continue. It will continue to be led by the emerging markets, where you do have the less well-off moving up the value chain, moving up the income scale, and joining the global consumer classes. And as they join those global consumer classes, then the demand for commodities is a given.
Coming back to the fact that after you did your stint with on researching commodities and their potential going forward, you went into trading, or essentially, which is called the long-short role on the hedge fund side. And that's not traditional investing, right? It's not all long, but you're also making money on the short side. Why did you take on this approach?
Well, so let me point out one thing that's often assumed and not always true. Not every person who is long-short is trading actively. Now, we happen to be people who trade actively in addition to being long-short. So, in a sense, in my opinion, in sectors like commodities, the value added of being able to find either subsectors or the whole market when you might have a major correction, if you're sitting there long only, you can get run over by the kind of painful corrections as we had in 2008, whereas being long-short gives flexibility to be able to take advantage of those times when either the whole market or all commodity sectors are coming off, or when there might be relative value trades where some commodities are positioned to do better than others, or some companies are positioned to do better than others. It's not always about making a commodity call. At the end of the day, we are equity investors.
The fact is that, short sales have called for a lot of criticism. And in the crisis that went by, a lot was attributed to how hedge funds made a lot of money in the crisis with shorting stocks. And there was a lot of aggression put in on short positions, which is why the market came off, which called for a banning of short sales in America. That's happening in Europe as well right now. What would you say, in defense to these positions being taken, given that you are on that side of the business? How does it impact you, even if it's for a short while?
Well, I think every academic study that I have seen, I wouldn't say ever done, but every one that I have seen, which may not be every one that was done of any credibility and size, has shown that short sales don't cause market falls. They actually contribute to market liquidity. And I think it is a common belief on the part of politicians that if they can blame, and frankly some company managements, that to blame all the problems in the stock market on short selling. Now, you could argue that in times when markets are falling, maybe short sellers add volatility, But even that, I'm not persuaded that that's the case. Obviously, when governments banned short selling, as they did in late 2008 and early 2009, it seemed to coincide with markets at least seeming to stabilize for a while. But I think that's a false connection to make, because the real turn in markets happened when you had the Fed doing quantitative easing and some of the liquidity problems going away. And I don't think the short selling, I'm not one of the ones who was persuaded that the short selling was the cause of all the sell-offs.